Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be taking a look at the top 10 stocks to buy for 2025 according to Barron's. In this video, we'll go through the recent publication and I will give you guys my thoughts on each of the stocks that they have chosen for the next year, as well as we'll take a look at the stocks they chose for 2024 and see how those performed so far. During the video, if they discuss any stocks that I own myself, we'll also take a look at my own personal holdings in those companies so that I can remain transparent and show you guys how I've performed so far within those holdings. If you guys do enjoy this type of content, consider subscribing to the channel. I'm on my way to 2K and I would really appreciate it. As a reminder, this is not financial advice and I'm just merely sharing my opinions on this channel. Real quick, before we get started, let's take a look at my portfolio dashboard. So in total, I've invested $35,470 and my current portfolio value is sitting at $49,512, which I do believe is the highest it's ever been. Now that really does put me right under 50K, which is my next big milestone I've been trying to hit for quite some time now, and I actually have the cash on the side to be able to hit that right now if I decide to, but I think I'll wait till the new year to do any more investing into this portfolio. My total return sits right under 40% and it was a little bit higher a couple weeks ago, but as I've invested more money into my account, my cost basis has gone up and my total return has gone down. My unrealized gain is pretty big at $14,042. I've earned $1,405 from dividend income so far, and my yearly projected income going forward is almost $800 per year. So getting right into the publication, we can see that right here, they already mentioned Alphabet, which is the parent company for Google. So we know that they're going to be probably talking about Google and recommending it as an investment for 2025. So as they first mentioned here, the Magnificent 7 stocks, which include Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, have so far dominated the market in 2024, producing outsized returns compared to a lot of the rest of the holdings in the S&P 500. Now, what I find interesting and what I respect about the article is they are taking a bit of a different approach in terms of their top 10 favorite stocks for 2025. They're not just going right into the Magnificent 7 stocks, but rather looking outside of that into other stocks that could produce outsized returns in the next year. And now based on right here, we can tell they are taking a value-oriented investing approach, so we'll see if their holdings match up with what they are saying. Now before we take a look at their 2025 holdings, let's take a quick look at what they recommended for last year, 2024, and how they performed that year. So if you scroll all the way down, you can see their top 10 favorite stocks for 2024, and they are very open about the fact they did trail the market with their choices. A big loss with Hertz Global overwhelmed the gains from both Alphabet and Madison Square Garden Sports, and because of that, they trailed very significantly to the overall market. Now that does bring up a very important point that I want to clarify right here. Investing in a multitude of different stocks and constantly recycling which stocks you're investing in is not always the most efficient approach, especially with all the tax implications that you might have in a regular taxable brokerage account. For example, if you make a pretty large profit off of a company like Google, but then you decide to sell at the end of the year, you're going to have a very large tax liability and that could overall hinder your gains on the company. That's why a lot of successful investors, including Warren Buffett, emphasize the benefit of holding stocks long term. The reason a lot of active traders, financial advisors, and hedge fund managers tend to underperform the market is not only because of the large fees that they charge, but also because of the tax implications of their trades. Because of this, a majority of traders tend to underperform the S&P 500, and that's why I hold such a large position in S&P 500 index fund like VOO. Although I do enjoy these kinds of articles, especially those from Barron's, I wouldn't recommend just buying 10 companies one year, selling them all out, and buying 10 new companies the next year, which is not necessarily what they're recommending here, but just something to keep in mind when you're investing. So you can see here, they recommended Alibaba Group, and that was a 23.7% return this year, and we'll look at their performance in a little bit. They also recommended Google, which was very good at 47.9%. They recommended a gold mining company, which only had a 3.1% total return, which is not that strong, and Berkshire Hathaway, which is not that bad at a 30% total return. Now, out of these 4 holdings so far, I do like Google and I like Berkshire Hathaway. I think both have good chance of outperforming the market in the long run, and so it's not so bad of a choice. Now next we have BioNTech, I hope I pronounced that right, and we have Chevron and Hertz. We can see here that Hertz performed terribly at minus 55% total return, and although it might have been hard to see, I don't think this was the best buying opportunity for 2024 regardless. Chevron was fine at 9%, but overall the energy sector had a bit of a hard time in 2024. Scrolling down, we can see they had Madison Square Garden with a 34.5% total return, which was very strong, PepsiCo at minus 3.1%, and U-Haul at 7.9%. Now, PepsiCo has had a pretty tough year in general, but especially since the elections, the stock has dipped pretty significantly, with investors being worried about RFK and what he might do to the snack food industry. Now, on average, Barron's portfolio performed with an 11.4% total return, which is not bad on most years, you could argue, because the S&P 500 average is 10%, but in a year where the S&P 500 performed at 30.7% total return, this is pretty weak. However, I do like the optimism here. Try again. It's important to not give up when you're investing in the market. If it's not for you, your investment strategy, maybe consider a broad market index fund, but if not, try to learn from your mistakes and grow through them. So in 2025, they are recommending some very familiar names. They're recommending Alibaba Group once again. The stock's about at $89 when they wrote this, and it trades for its 10 times projected current year earnings, well below Amazon's 45 times earnings. So what they're doing here is they're comparing Alibaba Group to Amazon, saying the company is worth at least a similar multiple to Amazon, or at least somewhere in between, and right now it's trading at a much undervalued rate. Additionally, it does have $50 billion of net cash, which is about 25% of its market value, which you could argue is a pretty stable foundation. Now, for myself personally, I'm going to stay out of Chinese stocks. I think I get enough exposure with global companies like Apple, who do sell a lot of their products in China, to not have to buy a specific Chinese consumer company. The Chinese government is not predictable enough, and the Chinese economy is just not quite strong enough right now for me to want to be investing my money into their stocks. Now, I will say that if I were to invest in some sort of Chinese company, I would probably consider Alibaba first because I am very familiar with the company, and of course, it is a very strong company regardless. Now, taking a look at Alibaba's stock price graph, we can see that at the start of the year, it was pretty low, and then it increased very nicely in May of the year, but it gave up all those gains basically going into July and actually went into the negatives. After that, the stock price did rally pretty hard, and I believe that was on stimulus news from the Chinese government, but since then, it's given up almost all those gains once again, down 24% from its peak, which is pretty pathetic. Now, this company could be a great long-term play, but for me, I'm going to avoid it for now, and I think taking a look at the 5-year graph cements that even further, with the company being very low compared to its peak, still down over 70%. I do believe that this company will recover eventually, I'm just not sure if it's going to be in 2025. Now, I'm a very big fan of their next company, which is Alphabet. That's the parent company of Google. Now, not only did Alphabet have a great 2024, but I think they're poised to have a pretty strong 2025, assuming there's no big market correction or recession. Now, Alphabet's stock price recently rallied, and that's because of news of their breakthroughs in their quantum computing chips. Even with the recent rally, pushing it up to $195 per share, it is still the cheapest of the Magnificent 7 and is trading at a forward multiple of 21 price to earnings ratio. Now, the closest one to that would be Meta at a 25 forward earnings ratio and Apple at a 30. Now, throughout the year, Google had several different buying opportunities. We can see here the first one was about in March of 2024 at $130 per share, where it then skyrocketed pretty aggressively all the way up to $192 per share in July. Then the stock price did dip again right here at about $150 per share in September, and I did take this opportunity to buy some more shares of the company. As the stock price increased, I stopped buying shares, and once the stock price dipped again here in November, I bought more shares at about $165 per share, and we'll take a look at my holding in just a second. Now, the reason for the dips we saw in the later part of the year was because of the DOJ and its pressure to potentially break up Google as a company and also categorizing it as an illegal monopoly. For me personally, I saw this as a buying opportunity, and like Barron did mention in their article, the sum of the parts could potentially be worth more than the company itself. So taking a look at my holding in Google, we can see here that my average price paid was $134 per share, but my initial purchase price was actually under $100 per share. I currently own 15 shares, and with the current stock price, we can see here that I'm up over 46% on the company, which is very strong. Now, the company has recently started paying a dividend 80 cents per year. My total annual payout is $12 for my entire holding, but over time, I hope that they do start growing this dividend aggressively. In terms of allocation, it's currently sitting at about 6% of my portfolio value, and I wouldn't mind making it a slightly larger position, but for now, I'm going to wait and see if there's any more dips and opportunities to buy more. Now, just for transparency, we can see here that my order history, my first buy was at $102 per share, and I bought one share at that price, then another one here at $98 per share, another share at $97.50, and two more at $93.55, with my last one coming at $85.32, and I really wish I bought more here at the bottom. Now, more recently, I bought 3 shares at $149.81, hoping that the stock price will continue to dip down, but unfortunately it did not, and then I bought 3 more shares at $166.93, and 3 more at $165. For me personally, I'm going to be looking for buying opportunities in 2025 to buy more into Google. I think the company is about fair value right now, and if it continues performing the way it does, I can see its stock price outpacing the S&P 500. Now, next we have ASML Holdings, which is a critical company to the semiconductor industry. This is a Netherlands-based company specializing in lithography machines that allow the production of high-performance chips used in smartphones, PCs, and data centers. Now, these machines will usually run you about $200 million or more, and if you guys haven't seen these machines before, definitely look it up. They're basically the size of a bus. Now, basically in the space, ASML does have a monopoly and no real competition for the time being, and I don't see any competition coming around anytime soon. Now, recently the stock price did have a pretty significant dip, falling over 20% in October, following a cut to its 2025 revenue guidance. Now, I actually have been considering opening a position in this company, but for now I've been holding off, but it's something I'm going to be considering in 2025, depending on which direction the stock price does trend. Looking at the stock price chart, we can see that in the past year, they are down 5.63%, basically giving up all the gains that they had at the beginning of the year. If you would have bought it here in January and held it all the way to the peak, you would have about 53%. But since then, the company has dropped over 33%, which is a lot. Now, depending on how you feel about the company and whether you think they're going to continue cutting guidance in 2025, this could be a very good buying opportunity if you've been looking to start a position here. For me personally, I'm going to be holding off at the moment, but I think Barron's made a good choice by adding this company into their list of top 10 holdings for 2025. Now next we have Berkshire Hathaway, and I'm not going to go into too much detail here. Every single one of you watching this video probably is very familiar with the company and the CEO Warren Buffett. Now if you don't know, the Class A shares have never gone through a stock split, so they trade at $695,000 per share, which is definitely something I can't afford, especially since Vanguard, my brokerage, doesn't let me buy fractional shares of companies. Now they also have Class B shares which have had stock splits and trade at a more reasonable price, which you guys can use to open up your position in the company. Now their operating profits are up 10% from 2023 in the past year, and they perform very well, with some people having a price target of over $800,000, which is crazy. Now currently the company does sit on $310 billion worth of cash, which is the largest it's ever sat on, but they do tend to grow their cash pile every year for the most part. But I do think he's been taking a more defensive approach, aside from investing in Occidental Petroleum, which some people have been speculating they might be making an acquisition on in 2025. Now currently I don't own any Berkshire Hathaway stock, and I don't plan on buying any in the future because I do see it as more of an ETF at this point in its life cycle. Berkshire Hathaway does own many large positions in companies like Apple, American Express, and Coca-Cola, but they also own companies in their entirety like Geico. Because of that structure, at this point I would rather invest in an S&P 500 index fund, but let me know down below what you guys would rather invest in. Now if you do want more exposure to insurance companies or more of a custom type of ETF, this could be a great company for you. In the past year, they are up 28.54%, but not too many big buying opportunities. In the past 5 years, they're up over 100%, meaning the stock price has doubled. Now, something that is important to consider here is that Berkshire Hathaway does not currently pay a dividend. They might do so in the future, but for the time being, they have a $0 dividend. The next company on the list is Citigroup, and for me this is not a great choice. It's not my favorite bank. I don't like working with Citi that much. I do have some of their credit cards, but in terms of banking, they're just not the person I want to be doing business with. Now also mentioned here is Wells Fargo, another company that I'm not a big fan of. I'd rather put my money in Chase if I'm going with a big bank, or maybe a local credit union if I want to do something smaller. Now they argue here that 80% of the revenue comes from 3 top tier businesses: a global services operation, a top 5 investment bank, and a top 3 credit card company. This year alone, Citi is up over 40% and still trades at a lower valuation than Chase. Now historically, Citi has been an underperformer, but Mayo says things are changing. They expect a stock double over the next 3 years, and if that does happen, that would be an amazing investment. Now their 1-year performance is very impressive, up over 38%, but their 5-year performance paints a completely different story, still down over 10%. Now this company has been pretty cyclical in nature, and I won't be surprised if we'll see a dip in stock price in the coming years. My main concern for Citi is their management team. I know they've changed a lot since these times over here in the early 2000s, but regardless, this big risk here is why I don't like the company. After the housing crash in 2008, the company basically fell 95.55%, and even today it's still trading down about 86% from its all-time highs. The company back here was mismanaged, and they were basically acquiring any company they could at any valuation they could, and because of that, eventually it all came crashing down, and all these bad investments had a very bad impact on the stock price and the company's performance. Now since the crash, Citi has done a lot of restructuring for the business and has changed their business direction, but regardless, I'm not sure I have the faith in the company that I would need to in order to invest in it. Next we have Everest Group, which they argue is trading at 6 times forward earnings, which is one of the cheapest stocks in the S&P 500. Now just because a company has a low price to earnings ratio does not necessarily mean that it's undervalued, and like they mentioned here, this type of valuation is often associated with troubled companies. However, their argument is that Everest is the 4th largest global reinsurer with high returns and impressive growth in recent years. Now in the past year, their performance has not been great, up only 2%, but the argument could be made that the following years could be better if they continue growing as they have been doing. The company aims to generate 17% annual shareholder return through 2026, and if it can achieve that, the stock could go up 50% in the next 2 years, which is not a bad point to make. Now as Scott Black mentions, it's not going to stay at a 6 multiple forever, but that could go either way. One, the company could of course drop below 6 multiple or get bought out, or it could actually increase and have a proper valuation if it does perform well for the next couple years. For me personally, I'm going to stay clear of this company. I would not be investing in it currently, and I have to do more research to decide if it's a worthwhile investment for me. Next we have LVMH, which is a top luxury goods company owning names such as Louis Vuitton. Now the reason for the discounted stock price in the past year is because of weak earnings and especially a weakness in the Chinese market, which is a very important customer of theirs. Now, what a lot of investors are hoping for is for stimulus checks to be pumped into the Chinese economy, potentially leading to more sales in companies like Louis Vuitton. Now, for me personally, I'm a very frugal person and I don't ever buy any sort of luxury goods, so I can't ever imagine buying basically any brand under their umbrella. Because of that, this company is not in my circle of competence, and it's also just a company that I can't see the appeal for because I just don't buy those sorts of products and I can't understand what type of people would want to buy that. Similar to Alibaba, I'm not one to bet on or against the Chinese economy, and because of that, I don't want to be putting my money in a company that relies heavily on the Chinese market. Now, for those of you that are interested, let's take a look at their stock price performance in the past year, and we can see here that it's down 19.33%. However, if we do look at their peak until now, we can see that in November, they were actually down 35.91%, and even now with the recent uptick, it's still down over 30% in stock price. Now, if you have been considering either opening a position in this company, or if you want to add more into your position, this could definitely be an opportunity to buy more if it's something you're interested in. Just make sure you do your research first. In the past 5 years, the company has performed fine, but it has been a little bit cyclical with a pretty big gain here in 2023, followed by a big drop, and then again a big gain in 2024, followed by a big drop. Now, sooner or later, if the company's earnings do trend upwards and there's a multiple expansion, the stock price will probably go up, but for me, this is going to be a pass for now. Next, we have Moderna, and this is a pharmaceutical stock, and for me, I'm just going to tell you guys right up front, this is a very big pass. I don't understand enough about pharmaceuticals. I think it's not consistent enough market, and it's not something I want to be involved with in terms of my investments. Now, I will give Barron's credit here. They are taking a value-oriented approach, and that's why they're mentioning Moderna, because the stock is down over 50% year to date. Now, the argument could be made that they can improve their fundamentals by cutting down R&D spending potentially, but for me, I'm just going to stay away from this company. Now, looking at the past year, the company is down over 58%, and it's not the only one in the industry. Pfizer has been beaten down pretty low as well this past year. Now, there's a lot of fears surrounding the new administration. They were not big fans of the COVID vaccines, especially not RFK, and so people are worried if there might be more reform in the pharmaceutical industry. Now, that would not be my main concern. I think it's very hard to touch the pharmaceutical industry because of just how much they spend on lobbying, but regardless, the company's just not doing well. The next company here is one that I'm not familiar with, SLB, and it's in the oil and gas industry. Now, same thing as Moderna, I'm going to tell you guys up front, I'm going to stay away from this company because I'm just not familiar with the oil and gas industry and it's not something I'm comfortable investing in. Now, the argument made here is that it has a strong corporate culture and is viewed as the ExxonMobil of the service industry, which for me is still not a big selling point. The bigger selling point here is that it has a fast-growing, high-margin digital business that uses cloud computing to help energy companies gain operating efficiencies. In the past year, they're down almost 30%. In the past 5 years, they're still down 5.68% with some pretty strong growth coming out of the COVID crash, but since then has just not performed that well. Now, their starting dividend yield is pretty nice at 2.92%, and if this is an industry that you are interested in investing into, you might want to take a look at this company for yourself. And last but certainly not least, we have Uber Technologies here, which has fallen over 30% from its October peak to about $62 per share. Now, the big fear that investors have right now is that they worry that robotaxis might bypass the Uber network entirely with their own applications, and that could happen for companies like Waymo, which is owned by Alphabet, and of course Tesla's robotaxi in the future. Waymo did announce it would launch its autonomous vehicles in Miami without a mobility partner, meaning that they're not going to partner with Uber in order to do this. Now, I agree with Barron's here that the concerns do seem overblown and that Uber's entrenched positions in many cities make it an attractive partner for robotaxis. Now, Uber's big concern here is not enough companies competing with robotaxi and Waymo. Robotaxi and Waymo could make their own applications, but if there were other robotaxis coming out, they might want to partner with Uber. Currently, robotaxis like Waymo are too expensive to scale. I think every Waymo car costs over $100,000 just to get it up and running, and that's not including the maintenance on the cars that are continuous. The problem with that is though that Google does basically have unlimited money, so as long as they want to continue funding this project, Waymo won't be going away anytime soon. Now, Uber's argument, of course, is that autonomous and human drivers are going to work together very well on its platform. That depends on if Uber is able to sign any sort of agreements with these big robotaxi companies in the future. Now, for me personally, I do agree with the Uber decision. I did buy the company myself and opened a new position, and since then I've added some more stock into the position as well. If the company's stock price remains deflated in 2025 or decreases in stock price, I'll probably be buying more into the company, but if not, I'll be happy to hold my position for the time being. If you guys want to see a video covering my initial buy of Uber and why I sold some of my Tesla shares, check out this video that I'll pin right up here. Now, if we take a look at my order history sheet within my spreadsheet, we can see here that in total, I have actually purchased 21 shares of the company at around a price of $60 to $62 per share. Now, short term, I hope the company's stock price continues to dip down so I can pick up some more at a discount, but if it goes up, I might add some more in the new year regardless. Looking right here, in terms of performance, actually my third worst performing company at only 1.81% total return, but it's also my most recent holding aside from Booz Allen Hamilton in the portfolio. My cost basis per share is at $60.61, and since the company does not pay a dividend, the only way to recoup some of the losses on some of my shares is to have stock price appreciation. Now in total, my Uber allocation is about 2.6% of my portfolio, and if the stock price remains lower, I'm open to making about a 4 to 5% position in my portfolio. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at Barron's top 10 stocks for 2025. I usually only post videos once a week on Sundays and don't usually post in the middle of the week, but I have so much content planned for the end of the year and the beginning of the new year that I had to fit this video in somewhere. If you guys do enjoy these middle of the week uploads, definitely leave a like on the video. It helps me out a ton, and comment down below which of the Barron stocks you're planning on buying yourself or that you already own and what you think about their list overall. Also, if you haven't yet checked out my most recent video that I just posted this past Sunday, check it out right here and show it some love, because whenever I post these middle of the week uploads, YouTube for some reason doesn't recommend any of my older videos. And if you want to see my video before that where I talk about buying Uber and selling Tesla, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.